For the first time ever, the front month WTI crude oil futures contract settled yesterday for a negative price. Many observers are wondering how this is possible. The crude oil future that briefly touched negative $40 per barrel is the WTI NYMEX CME contract, which expires today. The primary uses for futures are financial. Producers and consumers of crude oil can hedge their exposure, and of course, speculators can bet on rising or falling oil prices. Each futures contract represents 1,000 barrels of oil. Importantly, these contracts are physically settled at Cushing, Oklahoma. What that means is that traders with open short positions as of the last trading day must make delivery of 1,000 barrels, and those having open long positions must take delivery of 1,000 barrels within the delivery month. Cushing, Oklahoma was chosen when these futures were first created because it is a vitally important transshipment point for oil in North America. The economics of trading physical commodities is not limited to the commodity itself. Logistics such as transportation, delivery, and storage are critical components too. According to the Energy Information Administration, or EIA, Cushing had 55 million barrels in storage last week, 60% of the 91 million barrels of capacity. So at most, Cushing has 35 million barrels of storage capacity remaining. This is complicated further by the fact that oil has different grades. For example, light sweet crude cannot share tanks with heavy sour crude. Because most futures trading is for financial reasons rather than to actually commit to buy or sell the underlying commodity, under normal circumstances, traders will unwind their positions prior to expiration. But what if they don't? As of yesterday's open, the May futures had an open interest of over 100,000 contracts. That represents over 100 million barrels of West Texas Intermediate to be delivered to Cushing during the month of May. The holders of those contracts had to sell. Why? Even assuming Cushing could process that much oil in the delivery window, which it can't, that would suggest at least 70 million barrels of oil would be delivered for which there is no available storage. If the pipelines can't accommodate it, rail can't make up the difference. That's enough excess oil to fill nearly 100,000 DOT 111 rail tank cars, which would create a train 1,100 miles long. Of course, the shorts couldn't deliver that much oil either, but oil's price at Cushing is controlled at any time by its weakest link. And today, that weak link is available storage. The confluence of rapidly building oil stocks and open interest that vastly exceeded Cushing's physical capacity created a short squeeze, not of oil, but of oil storage. Some say that the negative price indicates that the market is broken. I disagree. The price of the futures should incorporate the logistics costs as well, and in this case, they're worth more than the product. I'm Mike Coe, and that's why the futures traded negative.